Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus, and we are here today with Paulo Aguilar. Paulo introduced real estate at a young age. When he turned 18 years old, he would go to school during the day and show apartments in New York City between classes. With that, he saved some money and entered into investments in Miami, Florida. He's always had a fascination towards finance and the investment industry, which is where he went to work after college. Moved on to a family office where he raised capital and built other fundraising operations before starting his own business. So, Paulo, welcome to the show.
Thank you, Mike. Appreciate it.
So tell me more about this. At 18 years old, you're kind of already jumping into the real estate game. How did you see that? Like, I mean, right now, my daughter's in college. She's 19, and I keep trying to push her towards doing some work that builds a skill set towards the future. And she talks about getting a job in a coffee shop. And not that a coffee shop is a bad job, but it's still kind of just trading time for money.
Yeah. I mean, it's to bring it back all the way until I was 18. I always had a fascination for real estate. My father was actually a real estate agent, right? And so he would actually take me when I was young to his showings and his listings, right? And so that's kind of where I was introduced to the whole real estate game. And, unfortunately, my father at a younger age, he had passed away. And so it kind of pushed me in a position to really find my way and make it on my own in that sense. And I was in this sort of path of finding financial security and financial freedom for me at a young age because of what had taken place with my father. And so real estate was one of the pathways that I saw. And I've seen how my father was very successful as a real estate agent doing it. And so I figured I'd dip my toe in it. And, while I was attending college, I was in between classes showing apartment rentals, and it was a good side gig, right? If you will. So made a few bucks there. And then at the time it was around 08, 09, where obviously the great financial crisis, the real estate market was just horrible. I mean, it was just tanking. And at the time, there wasn't really an opportunity for me to buy anything in New York because I was going to college in New York at Baruch College. And I figured, hey, why not look at another place? And Miami was where I kind of set my eyes on, just because I recently went there for spring break, obviously, as any college student would go to. And I loved the place. And I said, hey, this would be a great spot. I like the economy here. The fundamentals were strong. There was a robust economy, not just based off of tourism. And so that's where I started to dip my toe into real estate and bought my first condo there. And, that's led me to here.
So at that point, you were partway through college, like 21?
Yeah, I was around 21, 22-ish. Yeah, around that. Yep.
What's amazing? I remember that time, and a lot of people, because the world was ending,
Yeah.
it wasn't.
Oh, yeah.
That, I had just entered in my first medical practice, and we bought some cheap screens on Amazon and stuff like that. But it wasn't like, it was really scary to buy real estate right then. And as a 21-year-old, you saw the opportunity. Did you have any fear, or did it look like a sale to you?
It's a great question. I mean, to me, I was just at 21. I'm 37 now, right? So looking back, I mean, I was ready to take on the world at that time. I was ready to just go all in on something. And so that was my bet at that time when I was 21, where I saw a vision and I really wanted to go after it and make it happen, and, just carried on. Yeah.
That's awesome. Maybe it sounds almost like that. Like at 21, it's like that you're invincible, too dumb to know. And did the smart thing instead of chickening out of the smart thing.
Yeah. Well, if today, looking back now, if I were to put I basically put all my money on black at that point, right? I don't know if I would do that now. I've got a daughter, I'm married, right? And so I've got different responsibilities. Yeah. So things do change as life happens.
No, it's kind of a cool thing when you start into something like this at that young of an age, is even if you had lost it all because it's not as much and you don't have the same responsibilities. I had some friends in college who right after college, they kind of did the same thing. They got really good jobs but they had been sharing a room all the way through college. They were roommates, and then they got some other roommates, and they still slept in bunk beds and shared a room. And then they got great jobs. I think it was Credit First Swiss Boston, who eventually went belly up. But they moved to New York City. They did the same thing. They still lived in this tiny apartment. They slept in bunk beds, and they saved money, and they just shoved it away and invested it. And then eventually their company went belly up, but they did great because they didn't change their lifestyle.
Yeah.
And they started when the money started coming in, and they started investing, and they were young enough that there wasn't this concern of you didn't have the responsibilities. It's kind of a cool thing. I wish I had seen that vision when I was that young. And maybe
Hindsight's
there's
always
the difference.
2020, right?
Yeah, and I guess the difference when that I was a biology major, when your education is in finance, those things make more sense to you. They're not outside the norm. So then you finished school and started working in the finance industry in New York City. So tell me a little bit about how that. I mean, that's kind of right down the alley of what you're doing now.
Yeah, yeah. So I mean, for me, I've always had this fascination with investments, the stock and bond market, along with real estate. And I wanted to find some sort of intersection between, those two worlds, the investment industry and then also the real estate industry. And so what I did was I was investing in real estate, buying condos, bought a couple condos in Miami my first foray in real estate investing. But what I wanted to further do is further my skill set in the investment world, where I started as a private wealth advisor in MetLife. So it was basically an advisor cold calling on clients trying to help them with their insurance and managing their money, right? And that wasn't working out for me just because of how the team structure was, and it was pretty much a grind. And what I ended up doing was I pivoted into working for a financial institution that's focusing on real estate. So a real estate sponsor that was eventually listed public as a publicly traded REIT. And what I was doing for them was helping them raise capital on their internal sales desk. And I also was promoted a couple times as one being a client portfolio manager, helping educate the sales field and also going to investor meetings, educating the investors on what the strategies that the institution is executing on, what real estate strategies that they liked at the time. And, unfortunately, what happened was that the company had fallen into some trouble and they actually had to close shop. But that led me to another couple of other real estate institutions that I was, again, in the same sort of sales capacity, helping them raise capital, and eventually ended up working at my former stint was with a single family office out in the West Coast. And so help them with, again, raising capital and also building a business operations on how to do that from an institutional viewpoint. So, there's different channels of how to raise capital, whether it's direct retail, financial advisory channel, or even institutional. So think of family offices, endowments, foundations, other pensions, things of that nature, and just helping them kind of navigate and map out, the best way to market their fund strategy to whichever particular market they wanted to target. And so I ended up there. And then, as you had mentioned earlier in the conversation here, I thought the best move now was to then pivot and use my expertise and my skill set to help investors out, help and guide investors on their investments in real estate and other alternative investment. And so I eventually partnered with a senior advisor. He's a lot older than me, and we're partnered together to focus on these investors, particularly on the alternative and real estate side. So that's kind of how the string of timeline has taken place to where I am today.
It's interesting because a lot of things you talked about for a lot of doctors is because they don't have the same financial background. You go to college, you spend a lot of time studying, but it's not financial things. And the whole family office thing, it's funny because I hadn't heard of it till I got into real estate, and a lot of docs have still never heard the term. So just explain a little bit what a family office is and how that operates and why the average person out there has never heard of a family office.
Yeah, sure. So when you mention family office, you also need to be careful of how people define family offices. In the traditional sense, a family office is a single family office where a very, very wealthy family is managing their own personal finance individually, whether they have their own team in-house or they hire other external advisors to help manage that. What I think you're seeing now is that over, I would say, probably the last few years, is that you're seeing other advisors calling themselves as family office, right? But that's what would be called a multi-family office. They're essentially registered investment advisors that are catering to ultra high net worth individuals. So think of investors that are 50, 75, 100 million of assets to manage. That's who they're catering to. And so you may see that labeling, but you have to kind of peel back the onion and understand how their business model works. Where I was working with a single family office in that traditional sense. And so what's happening right now is sort of a evolution of this space. And I think there's going to be a lot of attention in the multi-family office space, if you will, because a lot of families and individuals are having lots of successful liquidity events and are growing their wealth. And they do need a lot of help in understanding these estate planning issues, tax mitigation strategies, and really other types of investments outside of just a regular stock bond portfolio. And so that's where this evolution of multifamily offices are also coming into play.
And so a lot of that, so for somebody out there who's a doc who's growing their wealth and maybe now they're young and they might be worth $1 million or $2 million, this idea. So these are people, families that have 20 million, 30 million. So it's or more.
Mhm.
And so the things that these offices are doing and the investments they're looking at are considerably different than if you walk down Main Street and you walk into your financial advisor with a door hanging on the side. That's kind of what I was digging into. And because when you see I think as I started into the real estate realm, I had no idea that there are groups out there who they're not investing $100,000 or $200,000. They're writing a check for $5 million or $10 million. And so they're looking at different types of investments, and that this whole, it's almost like there's these stepping stones in the financial world where you can do things if you're a lower level investor that there may be great returns on, but it's not worth the time of somebody who's got that much more to invest.
Yeah, I mean, there's different sort of tierings, if you will, of where you are in wealth, right? And so there's the mass affluent that's out there that maybe let's call it 500 to $1 million of assets, of investable assets, accredited investors, 1 million plus of investable assets. All right. That's not the technical term, but that is sort of the actual how I think of it as well. And then you've got high net worth individuals, 5, 10 plus million, and then above, call it 30 plus million is really the ultra high net worth individuals, right? And these are where the family offices start to come into play. But yeah, you're right. When it comes to the type of investments that they make, they are kind of like small institutions almost, right? And so I've talked to some family offices where the minimum check size that they'll make is, $25 million. So it's pretty substantial depending on who you talk to, versus a regular retail investor that has a couple hundred thousand, they're good for 25, 50K. There is a difference between how you're, for me, how the approach is going to be when speaking to these types of people, whether family offices or a retail client or an accredited investors, because the vehicles that are going to be presented are also have to coincide with, who you're talking to, because it really wouldn't make much sense. I'm just generalizing here. If a family office were to put in $25 million in a call it interval fund, right? And so they may want a little bit more special treatment, white glove service, different economics than a regular retail client that would buy into maybe like an interval fund. So yeah, it's to your point. There are these tierings, and there's lots of nuances to knowing these tierings.
Some docs, when we talk about this stuff, they're concerned that, like, well, if this was a great deal, somebody bigger would have already bought it. Where if it's a $3 to $5 million neighborhood retail center that can generate some great returns with somebody putting in $100,000, that somebody who, if their minimum check size is $5 million or $20 million, they're not looking to be part of the syndication in a $5 million retail center.
Mhm.
And so there's still these opportunities that, at different levels of investors. And I guess that was kind of part of what I was digging for, is you can invest in commercial real estate and make great returns, but it might not be, if you're looking to buy a $200 million office tower, that's a different thing than a $3 million neighborhood retail center.
Yeah, I mean, you're spot on with that. I mean, the economics are different. Just the entire approach is going to be different when you talk about these larger family offices versus a retail investor. Absolutely.
So tell me a little bit more now. So then you wanted to just briefly touched on it. The Wealthstone Group, you started with your partner. So then you moved out of the bigger institutional capital organizations, started your own group. What was the motivation to jump out and kind of go out on your own?
Yeah, I think that when you look at this, so to kind of step back, which I didn't mention, which I probably should have, which was I was also investing during my time in my career in finance, individually creating a portfolio with my wife, a portfolio of single families and multifamily, small multifamily duplexes, right? We ended up creating about 18 units, 18 doors over 9 different properties, right? And, I had a chance to experience that portfolio creation that we've done on the real estate side, actively managing it. And so what I've noticed was that it was tough, to scale that up, being also that we were managing these properties out of state. I'm here in New Jersey, and we were buying in the Midwest, in St. Louis, and also in Dayton, Ohio. And it was very difficult to scale that and manage it from where we are here. And so we ended up selling that portfolio pretty much all during COVID. And I found a couple of things that I learned was that I did not want to be in that business of property management. That was just not what I wanted to do, because that's what I was doing basically. Yes, we had property managers, but they were third-party property managers. They had no incentive really to help us out. And so we were managing the manager, and it was a real pain. And so that's something that, from a business ops perspective, that's not what I wanted to do. And it didn't make sense to do that. And so what we did was we said to ourselves, hey, why don't we kind of rethink this over and see where we want to take this, and go from here, just because we tried it, we didn't like it. What's next? And so the next iteration where Wealthstone Group comes in is that what I'm looking to do and help out our real estate investors and partner with real estate investors on their deals, right? And also help them with any of their tax mitigation issues that they have, right? Whether it's we can apply accelerated depreciation, cost segregation, things of that nature, or even 1031 exchanges, more importantly, which is very effective tax code that can be applied passively, right, as a passive investor through Delaware Statutory Trusts, DSTs as for short. And so I've kind of taken and morphed my experience from being an active real estate investor, having the finance background, and it's kind of led me to this, where really that's going to be my focus. And my partner and I are working with active real estate investors who are looking to go a little passive or have some a portion of their portfolio that they don't know what to do with it. So we'll help them manage, some of their investments on that end. And yeah, that's kind of where the vision is now, where I'm looking to continue my progression in my career.
I want to dig into this Delaware Statutory Trust a little bit more because, especially for a lot of docs where you have a high W-2 job, or even if you're a practice owner, taxes are a tough thing. And if you can mitigate your investment tax, that's a big whammy. And so as a passive investor, you can't really take advantage of a 1031, correct? Or how can you explain that to me?
Yes.
Because that was always my impression.
Yes, you can actually. So it's so the Delaware Statutory Trust, DST for short, right? It's basically, if you will, a fund, right? And a sponsor creates this vehicle, which is it's a trust, and it acquires a property, whether there's debt on it or no debt. That's that can be that can be situational. And what it does is that it basically syndicates out the equity that the sponsor put in, right, to investors that want to buy into the property. So what this does is that a couple things. So if an active investor, right, is selling their property, they can't find something on the MLS or off market deals with the real estate broker. This sort of expands the options for them to look at and identify a property, a replacement property, being the DST, right? The one thing though is that these are passive, right? Because you are effectively investing in a sponsored fund that the sponsor has full control and management of the entire, operations and when you're going to exit. And so, that's the one thing that, you're giving control completely of your investment to a sponsor. And so it's important to know, who really these sponsors are and who to trust. Because at the end of the day, we're in the business of trust, and you want to be able to be comfortable, sleep well at night, and understand that your dollars are safe.
So how does the DST differ from just a more standard syndication? Because it's, if you invest as a limited partner, as a passive investor in any syndication, you kind of don't have a whole lot of control. But how does that, if just a standard syndication versus using that DST for the syndication?
Yeah, so I mean, from a syndication standpoint, it's typically how they're structured. It's an LLC, right, and or a partnership, and that's technically not real estate, right? And that's those are securities from the eyes of the IRS, and that differs completely when you are looking at, let's say, a Delaware Statutory Trust, being that the way that it's structured is a trust with a master lease agreement that overlays the trust that then owns the property, right? Not to get too technical, but that's the basic gist of it, right? Of the IRS sees the DST, Delaware Statutory Trust, as a direct real estate comparable, right? Versus a syndication in that sense.
Okay. Now, does the when the deal is sold, or is there return of capital? It kind of works the same way there as far as the investor is concerned.
Yeah, yeah. So whenever the deal is sold, they have a liquidity event or exit. Return of capital goes back to the investors. So just to kind of back up here, what they'll do is typically sponsors, they'll send out a letter of intent or a letter of direction agreement to where they want their proceeds to go, because keep in mind these are 1031 exchangeable, right? And so investors, the sponsor needs to know where to send these proceeds, and so they can either the investors can elect to receive the proceeds, to a qualified intermediary, or if they want to pay the taxes, they can just receive it and then pay the taxes then. Now that gives them the option to either pay the taxes, as I mentioned, go back into another DST, or go back into real estate directly and manage it themselves. So they always have those three options at hand at the end of every DST cycle.
So the difference being, if this were just a non-DST syndication, at the end, when you have that liquidity event, at that point, you can't roll it into a 1031 or send it to a 1031 intermediary. But if it's a DST, you can. That's how it avoids the taxes along the way and allows to let it to grow or defer those taxes through the
Yep.
1031 model.
Yeah, exactly. DSTs allowed full tax deferral and is 1031 exchange eligible. And syndications are, for the most part, being that they're structured as limited partnerships, LLC memberships, right? That is not 1031 exchangeable.
That's great. That's see, I just learned something really cool today. And I think the other great part for a lot of people who are newer to this, and I always mention it because when I talk to doctors, they always get skittish that there's something funny going on here when it doesn't match up with what they're used to. So to hear about something like this, that and just to know this exists and it's a legal structure and it's not a scam, that's the thing I call docs. As soon as it doesn't fit within their current paradigm, they're like, oh, this has got to be a scam. There's something going on funny here. So it's always nice to hear about this. And then if they see it, they're like, oh, this is a cool thing. You still got to do your due diligence on your
Yeah.
sponsors. You still got to look into it, but it's another structure that exists that allows you to defer taxes and possibly term for forever.
Yeah, absolutely. And to the point that you're making, that it is legit. It's not a scam. This is a real business. It's been around for, I would say, the last 14 or 15 years, right? The DST business. It originally was the TIC. It was securitized TICs, tenancy in commons, right? And so you've had these institutional sponsors come in and create these structures for investors to come in passively. And that kind of I wouldn't say went away, but it's definitely not the choice, the top choice for passive investors and sponsors, especially to create these types of structures back when 0809 happened. Because again, ticks, they don't have, sponsors don't have full control. There's 35 investors limitation, right, of having ticks in one deal. And that poses a few problems. And what ends up happening is that, to give you an example, is that back in 0809, the story was when I was working for one of the sponsors, was that they were trying to sell a retail property in Texas. And this was back in '08, right? And think of it where the market was at that point. So they had the right game plan, which was to sell in '08. But the issue was that you need unanimous consent for all investors in a tick structure. And what ended up happening was this one investor who so happened to just have his morning coffee every Saturday there did not want to sell, and he blew the whole deal up. And so the whole deal fell apart. They couldn't sell because of this one guy, and they weren't able to, they didn't sell, and they ended up losing money because of that. And so that arrangement sort of fell out of favor because of those types of issues that were being set in place, right? And so the Delaware Statutory Trust came into place because of that. And then since then, at the peak of its equity raise, the entire market has raised over $10 billion of DST 1031 exchange dollars, right, from passive investors. And this was about a couple of years ago. The market's taken a little bit of a dip because of, this is a very transaction-based type of industry. Whenever transaction volume is low, that's DST dollars are going to be low too in this space. And so just wanted to mention that so that you have an understanding of like the evolution of this entire industry and where it is. And it's a real business. It's a real industry that exists.
And so for anybody's listening out there, if they haven't heard of the TIC or the tenant in common is basically another structure. And this one I've been a little more aware of just from a doctor's standpoint with practice owned real estate. Well, not practice owned, but real estate that was owned through a separate LLC and that we had used a tenant in common. And it's just basically structuring it different than if the individual people owned it. So the sale of that building at whatever point in time, it could go through a 1031 exchange. So that's one that, and I think the difference with a tenant in common, if it's 2 or 3 or 4 people and you have to have a unanimous sale agreement and you all work together and it's all part of the same business, kind of is a little different than that's interesting. I'd never even thought of a tick that way, that you used it to put together 15 partners. And you said 15 was the max?
35 is the max. Yeah.
Because, wow, you got a unanimous vote out of 35 people.
Yeah.
That's
well, that's where that was the Achilles heel of the tick. And to think of it like this is a great way for sponsors, right? 1031 exchange dollars are a great way for sponsors to capture new equity to buy deals, right? Because they're motivated to buy real estate, right? And they need to defer their capital gains, and they got 45 days, so they're kind of under the gun here. So
yeah,
it's a great way for sponsors to raise capital.
And it's a great opportunity now for people who are investing passively to get some of those advantages that typically would be more just available to somebody who's more active in doing 1031.
Absolutely. Yeah. I mean, you get the same advantages as you would if you were actively managing it. The only difference is that you're not dealing with tenants, toilets, and trash, right? And so it's that is the upside. The return profile is going to be a little bit different. It's probably going to be lower just because it's not you actively managing it. It's another sponsor. So the returns are not going to be as juicy, if you will, versus a actively managed property.
Okay. So, and I'm looking through your profile here. At some of these, we've talked about the DSTs, the TICs, the LPs. So the other is a QOZ fund. So tell me about that one.
Yeah, the QOZ fund. So that was first introduced back in 2017 by the Tax Cuts and Jobs Act. And effectively what that is that this allows sponsors to buy real estate in QOZ tracts. And there's about 8,700 QOZ tracts, right, that are across the United States. And this was all elected by the governors of the US to submit to the treasurer. And they identify these QOZ as economically challenged neighborhoods or areas, right? And so the whole point of the program, the QOZ Qualified Opportunity Zone program, is to really help these economically challenged neighborhoods in these QOZ. And what that allows is that sponsors and investors who buy into these tracts and develop real estate or a business that allows for the neighborhood to flourish gets certain tax benefits, right? When it was originally introduced back in 2017, there was a couple of benefits that are no longer available, which is a step up in cost basis, right? But being that where we are right now in April of 2024, the only real benefit right now for any investor sponsored to buy into these QOZ is one, deferral of capital gains tax, not until 2026. And then if you hold it on your investment for a 10-year period, so let's say 2024, 2034, the gains from your investment itself, you won't have to, are eradicated. You don't have to pay any capital gains on any of the profits that are made from the investment itself. So those are the two real benefits right now where we stand. Now, there's been some talks, it's been going back and forth about Senator Tim Scott and how he's the one that introduced this legislation and pushed for it. He's attempting to reintroduce other legislation again to extend these benefits and also reintroduce the step up in cost basis. And so there's still more to come on that. I'm not sure where we're going to be in the next few months, given that this is an election year. But Congress, Senator Scott, and it are trying to find ways to continue this program for investors.
I'd really like to thank Paulo, because this has been a great introduction to some of these more complex financial structures that are available out there and that these things are real. And I'd like to thank our listeners for being here and joining us today on this episode of Surgeon Syndicate. And please join us for the second half of our interview with Paulo, as we're going to dive deeper into some of these complex structures for real estate deals. So join us next time on Surgeon Syndicate. This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.